And then I want the listener to understand a bit about your experience in commercial real estate beyond
Sure.
apartment buildings. Because
Yeah.
last time we talked, we were talking about, like, I'm probably not saying this correctly, but you would buy vacant land and build retail and industrial and office spaces.
That's right.
Right?
Yeah. So we would
and
do
quite a bit of square footage, not small projects. Like
yeah. Well, I mean, it's all relative, I suppose, right? Because like some of the developers that I'm aware of and that I was out cat skiing with these guys. I mean, they look at what I'm doing and it's kind of small potatoes, right? Because they might do
maybe smart centers think you're small, sure.
Yeah.
You're not building a Costco, right?
So you're right. We did 3 industrial buildings that were about 37,000 square feet. And we bought the land about 3 acres, just under. And one of the things that we did on that, and just if someone isn't aware, we were like, one of the big things I learned about the developments, the kind of 1,150 acres we did in Muskoka, so just north of you, was the importance of leasing and selling and verifying demand in the market. I think that's kind of one of my principles, if you will, is never to take something at face value or for granted. So what we did with the industrial is we gave ourselves 4 months of due diligence, right? So similar to when you go and buy a house, just think if the seller gives you 4 months to find a tenant and make sure that there's market demand. When you're doing 37,000 square feet and you're basically selling off of plans, because we didn't have anything tangible, right? It was basically, here it is on paper. So it took some time, took some selling, took some real effort, if you will. But long story short, it came together. We were about 75% pre-sold before we removed conditions, and by the time we actually closed on the land, we were 100% sold. So some developers might look at that, and say, well, Shane, you capped your upside. And that is true. But I am far more risk averse. And the difference between industrial and say multifamily, like, there's right now we're doing some multifamily and I likely wouldn't do that because I'm not as nervous about where the market's going to be in 12, 18 months. In industrial, we had those buildings up in 6 months. So from start to finish, we were in and out of that deal in less than 16 months.
Wait,
So
you're taking a raw piece of land,
yeah,
and it's something that a tenant can move into in 6 months?
Yep.
Or at least a shell.
I will say, so it took about 5 months to get our DP in place, and then maybe another, so that's your development permit, and then maybe another 2 months to get your building permit. But as soon as you get your development permit, that's when you can start doing your foundation work, right? Because you get a partial permit to do your foundations. And it's incredible. Like the contractors, I mean, when you look at the buildings, because you're just building a shell, right? We didn't build out interiors. We put demising walls and obviously all the mechanical. But at the end of the day, we had, from the time we kind of put a shovel in the ground, it was about 6 months, because I think we started in April and we turned over in November.
I'm sorry, Shane, we're going to probably have to keep you here for a while. How does the financing work for a deal like this?
Well, that's a big part of that was why we didn't build on spec or speculating, right? So what we did is we went direct to RBC, but I would say for the most part, if you are new to doing development or even commercial real estate, I come from commercial lending, right? So I understood that world. So we felt comfortable to go directly to the bank. But in most cases, you would probably use a mortgage broker that's going to understand the various programs that are out there. But because we hit our threshold, and I think our threshold with the bank was 65% pre-sales or pre-leasing, we were doing for sale. And essentially, you just put yourself in the bank's shoes, right? So the bank says, okay, you're going to put 30% equity, plus or minus, right? So we bought the land outright, and we had some of our soft costs that we front loaded. So, so the bank's saying, okay, so then we're going to lend you, let's just say it's $6 million in this. It was more than that, but plus or minus. And so the bank says, okay, if you get 65% pre-sales, then we're out of the deal, right? And then my equity is the next at risk. And that's probably the next 20%. And so what happens is it's really the last 15% is where all your margin is. And so for a lot of developers, they'll even say it's, they don't make money until they sell out that last little bit. So if you hold on to 5 or 10% that you can't sell, that's where you can, your profits get delayed. And one of the things, knowing that, I told our agents that were selling these, I said, oversell it by 125%, get me backup offers, because I'd never, you never know if someone's going to back out of a deal. And we had some people come back and try to grind us on price or try to back out. And so we just had backup offers. I mean, it's just essentially, putting yourself in the best situation. When there's more demand than supply, you're in the driver's seat. But if you're scrambling around and you're at 88% and you're just like, you can't sell, now all of a sudden, because there was a development right behind us, and they had a bit of a different product in terms of not as usable. They started 6 months earlier, and a year later they were still trying to sell. And so, I mean, that's, and they, they had a bit of a different debt structure and equity capital stack, if you want to call it that, in terms of how they brought money in. They tried to do it without outside investors. And there's good and bad to that, right? But because their project delayed, I'm doubtful they were profitable. I don't know all the numbers, but I just, I can figure it out on my own, and right. I think that they probably didn't do nearly as well as they thought they were going to.
Obviously, a lot more risk and headache.
Absolutely, yeah.
Crazy. I don't even know where to go next. So how do you structure this? So was this all your own money, or did you raise the equity?
We had about 15 investors.
15. Wow.
So we would do what's called a syndication. And my partner and I put in, 10 to 15% of the equity, and then we'd raise the balance from our investors. And, a lot of these individuals have been with us for 10 plus years, right? And so they've seen a track record. There's a lot of trust, and obviously still have to put together a business plan that makes sense. But I mean, I'm trying to think of a good example. One of the things that we did, I think, really well on this was we went to our investors once the deal was what I call baked, right? If I came to you, Erwin, and I said, hey, I got 3 acres of raw land, and this is the plan. We think this is going to happen, right? And I show you all the, fancy graphs and everything else. Well, people that have money, they're going to look at that and say, okay, well, what if you don't sell? What if the prices are lower? What if this? There's like a million what ifs. But if I say, look, I've already got contracts and I've already got deposits in place, and I've already pre-sold 70% in the past 6 weeks, and we've already got, letters of intent for the other building. So here are the numbers. Okay. So the numbers are going to be whatever, 30% returns, 35% returns. And now it's basically like, do you want in or not? Right. There's way less questions. Really, the questions are, A, can you deliver this? Can you build it on time? And can you build it on budget? And so that was, where my partner really comes in, because he's got the construction experience. I'm learning it, but I wouldn't say that I'm an expert, contractor or developer.
Interesting. Okay, Shane, you're going to be here for 3 hours at least, because we got to dig into all this. There's just so much to unpack. Like, we still have to cover, like, what did you offer the equity partners?
Yeah.
Let's start with that. Can you
Sure.
touch on? So you mentioned syndication. Would this also be considered private equity, or is syndication the only way to refer to this?
I mean, I'm trying to think of
There's some sort of form of joint venture.
It's different than a joint venture, and so this kind of falls under like private securities, right, where they are illiquid, and we're going to family and friends and accredited high net worth investors. I'm not like a securities lawyer, and so I don't want to give any kind of information that might be taken out of context, but I'll just tell you how we did it. So we put together essentially an offering memorandum. It's not a full OM or offering memorandum, but that's probably what some people would be kind of familiar with. And we would go to our investors with our pitch deck or investor presentation, and we'd say, look, I'll use you as an example, right? So I'd say, Erwin, here's the opportunity. We're raising, for easy math, $3 million. And, it's probably going to be a 2-year play. And in exchange, if you put in, just say for this example, $100,000, we're going to give you an 8% preferred return. Okay. So that doesn't mean guaranteed. It just means the first 8% on an annualized basis, you're going to get that. Plus, I'm going to give you 75% of the upside. Okay. So, and Shane, as the general partner, here's how I get paid, right? I'm going to get paid up front for an acquisition fee because I risked $45,000 to put this deal together, right? I've got architects, I've got due diligence, geotech, all the reports. And, I'm coming to you with a deal that's ready to go, not with an idea. And you don't have to risk any money. If the deal doesn't come together, you're okay. It's my money that's on the line, so to speak. Plus, I sign on all the personal guarantees, so my house becomes collateral to the bank for the build. And then in exchange for that, I will get what's called a syndication fee, or putting the deal together, and I'll get 25% of the profit and upside. And because we were a developer on this, we took a project management fee. Now, if we weren't going to project management or manage it, we would probably have someone else, because a project manager is basically holding the general contractor accountable. All right. And I don't want to get into too much of the details because I don't think many people are, some people might be doing developments and whatnot, but that's kind of the high level. And so investors look at it and say, okay, so my risk is the $100,000 that I put in. I'm not guaranteeing the loan. I have no other exposure, right? There's provisions in these agreements for cash calls. So you definitely want to be aware of that. And what does that actually look like? But that's essentially how these syndications, LPGP agreements are structured. Does that kind of make sense?
It's fascinating stuff.